I guess on time is just as good of a time to start as any. So I'll go ahead and get kicked off. So good afternoon. Thank you for joining us for another session of the Entrepreneurs Bootcamp. This session is how to make smart projections with Larry Kammerer. The Entrepreneurs Bootcamp series is brought to you by New Ventures, a series for our brilliant inventors on what to expect when you're expecting a new business. So please join us for the rest of the series going on all spring, presented by our partners to familiarize you with the gritty details of establishing and running your own startup. This is the fifth session in this series, brought to you by Larry Kammerer, as I mentioned, a partner at Moss Adams. Larry, I'll just hand it over to you now, and you can introduce yourself in this session.
Great, thanks, Matthew. Let me try to share my screens so that and hopefully you're seeing how to create compelling cash flow projections. Are you seeing that?
We've got that.
All right, great. Well, thanks, Matthew. Thanks everyone for joining. You know, we're going to be talking today about how to create cash flow projections, and we're talking about the kind that you use for fundraising for an early stage startup. But what we're really focusing on is the word compelling, hopefully. So we want the cash flow projection to really tell the story of your business, or to help tell the story as part of the overall pitch of what you're trying to explain. So we've got some ideas, some practical ways that we think we can help you to tell your story and through the compelling projections. So let's dig into that a little bit. You know, first a little bit about Moss Adams, which is the firm where I work. It's to summarize it, we're a really big firm, which often doesn't sound so great to early stage startup companies, but I'm lucky to be part of a smaller group within the firm. I'm the partner in charge of a group we call Outsourced Finance and Accounting, and working with early stage startup companies, and then even mentoring companies before they form or as they're forming, is what we're all about, which might surprise a lot of people who know that we're a big firm. And I like to think of that as the best of both worlds, and that, you know, we work with our clients and can help them and be nimble and cost efficient, you know, early on when money is really tight. But then as they grow and have more needs, if those needs exceed what my team can provide, then it's good to be a big firm, because we have a lot of other resources as you start to go international, you know, or looking for tax credit help and things like this. You know, we're really deep bench there that I have access to that talent to help the clients I'm working with. I've been working in this area for a long time, doing outsourced accounting. I love it because I love helping people to create and run the best possible businesses they can. So, you know, accountants are usually, you know, executing transactions and telling history, you know, looking backwards, and certainly we do part of that too. But I think that's just kind of the table stakes for getting in the game. What do you do with that information? How can we harness that information that we have in the accounting and look forward to help companies see things coming, help see issues coming, and help them avoid issues and take control of opportunities. So that's what turns me on about what I do. Love working with entrepreneurs, and the passion and the energy that comes with that. So I have a great deal of respect for what all of you do, and would love to do anything I can to help you advance. This topic is fun for me because you know, like I said, accountants are always in the past. This is looking forward, which accountants rarely do. And the other thing that's different about this for accountants is that there are no hard and fast rules about how to look forward and do a cash flow projection. When we're doing accounting and looking backwards, there's tons of hard and fast rules about this is how it has to be done. So what I'm going to tell you today aren't rules that you should carve in stone. They're what I consider best practices. It's a little bit of art more than science. And like all art, beauty is in the eye of the beholder. So just as sure, if you follow my advice and do some of these things, it wouldn't surprise me at all if somebody listened to your pitch deck and said, why did you do it that way? You should have done it another way. And they're not wrong. So just a little caveat there before we get started that this is my opinion based on a lot of years of experience of helping entrepreneurs with their cash flow projections and going through their pitches. All right, so let's dig in. Before you sit down to create your cash flow projection, there's some things that you should keep top of mind before you even start. And what outcome are you trying to get? I mean, who is this cash flow projection? Who is our audience? The types of investors that you're looking for will help kind of determine maybe some of the ways that you would build the cash flow projection. How much money will you need? When oftentimes people don't know that at the beginning, and that's okay. The cash flow projection might help to do that. It is not uncommon at all to iterate many times where you just go into it and you say, what do I need to get, to reach a certain point where our company becomes more valuable? How much people, how much money does it take? How much time does it take? And the first time you do that, it's not uncommon at all to come out with an answer that probably isn't going to get funded. It takes too long or it costs too much. And so it's not uncommon at all for people to go in and say, I don't know how much money it's going to take. But before you go raise money, you clearly need to have that straight. But by creating the cash flow and iterating it, you can help answer that question. But if you know going in, that's great. A lot of people don't, though. Yeah, sorry about that. I got a duplicate slide in here. The next thing I always think about that I advise people on building a cash flow is it takes longer than you think. So start earlier than you think. If you have a big meeting, the next morning, that's probably, not the best time to start this. I think it takes easily 40 hours because of the iterations I was talking about. So, to keep iterating and find a way that gets you to an answer that has a good chance of being funded, it takes a long time, possibly, 40 hours, sometimes more if it's a complicated situation or you're using a complicated format. And so most people underestimate how long it takes. Takes longer than you think. And not just time put into it, but elapsed time, because you'll see later, I think it's more than a one person show when you're building one of these cash flows. You get really deep in these things and you can get a little blinded. And so it's good to take a step back, maybe show it to some of your other advisors. And so it just takes elapsed time as well, not just time into doing this. So as good as we might do on a cash flow forecast, we create the best, most compelling cash flow forecast ever. It's not going to help you that much. I like to think of this as I've seen deals that didn't happen because there were large holes in the cash flow forecast, but I've never seen a deal get funded because the cash flow forecast was great. That's not how deals happen. So this is just something you have to do and you have to get right, but it's not the magic ticket to getting funded by any means. A lot of people ask me, what software should you use? And there are different softwares out there. I've never used any of them. It's not like there's a magic software that's generally accepted that people would appreciate knowing. We've always just used Excel to build these. However, we do build templates in Excel, and we've got two different versions. We're going to show you one of those versions today, the more simple version, that helps kind of focus your thoughts and produces an output that will look normal to most investors. It's what people do. And so I'm not against software. I just don't think you need to in this case, and most people don't. And the last point here is I get a lot of calls asking, can I hire you to build the forecast? And there are people out there that definitely do that, and they do a good job. I just wonder, I don't do them. I don't take on those projects because it is something really hard to completely outsource. So to really do this right, you have to have a knowledge of the business and what the founder or the founders are trying to do. And the time that it takes to transfer that knowledge to someone like me, to then lay it out and then hand it back to you, and then you have to go pitch it to someone who's going to start asking you questions about this forecast that you didn't even build. I just don't think that works that great. But long ago, I used to build these. I used to go to pitch them and serve as someone's interim CFO in these pitch meetings. But if the entrepreneur who's leading the effort doesn't have a business person's command of the projection, it becomes pretty apparent fast. It's not okay to say, Larry will answer that question. You have to be able to answer the questions at a high level, at a business person's level. And so if you have to know it that well, I think the best way to know it that well is to build it. And I think a better use of time for someone like me is to help you with to funnel your thoughts, provide you a template of how you could build it, let you go build it, let you come back and talk, and we can iterate and look at it and tell you what's probably wrong with it, make sure that the math is right. That's my opinion, that you can't just send this to somebody outside of your team to do. You really have to do it. I think that's the practical answer from what I've seen. I'll stop there for a second. If you have any questions, Matthew, would you be able to see the questions? Happy to take questions along the way if they come up, and I think we would do that on the chat feature. I'm worried that I might miss them. If somebody would maybe, Matthew, is that possible that somebody could jump in?
So my plan is, as questions come up, we can add them. I can interrupt you, or we can. I can wait until a lull to let you know about them.
Yeah, and we'll have time at the end as well. This won't take the whole hour, so and we'll have time even beyond the hour. I'm happy to follow up, individually with you as well later. So there'll be plenty of opportunity, to either get your individual questions answered if it's not appropriate to ask in front of the group. But we'll also have time at the end. And if something just jumps out with what I'm talking about, just go ahead and chat in the chat function. All right. I think one of the most important things is to be able to tell your story simply and clearly. And I've listed what I mean here, but I think it might be helpful to go to an example of what a cash flow spreadsheet looks like that I'm talking about, that I think is fairly simple and clear. And then maybe we can kind of highlight some of these points here. So here I've got a 2-page cash flow forecast. So there's the year 2016, and 2017. So that's it. That is surprisingly simple, a format that most people are, it's simpler than most people think. And most entrepreneurs will push back on me and say, this is too simple. You don't understand, my business is complicated. And no doubt it is, or could be. I don't think complicated behind the scenes has to equal complicated on the output. If you get a pitch meeting, you have a short period of time to gather someone's interest. What we're trying to do here is just give somebody a high-level overview of what their investment would do for this company and where the benefits and the risks are. We're not trying to ask every single question. Sometimes you don't even get a meeting. You have to send this in first. So you want this to speak for you along with your business plan and your pitch deck. And so, you know, a lot of detailed folks, you know, want to get more detailed. And I definitely, you have to get detailed to build this. But what I'm recommending here is a very simple, output that we would share people. So detailed input is okay. Summary, high level output is what I think we're looking for here. We're just trying to start a conversation. We'd be thrilled for someone to say, this doesn't tell me enough. What, you know, what's under these numbers, you know, what, we welcome that kind of conversation. We're trying to use this to start the conversation. So a couple of things to point out about what I think are important in building a spreadsheet. And by the way, this comes from one of the two templates I was talking about, and happy to forward this on to anybody. There's more behind building this than you can see here, the inputs, but it's really still not that very complicated. So anybody who would like to have this, I'd be happy to forward it on. You could email me anywhere down the line. I'd be happy to send that to you. But a couple things. So we talked about showing the output and not the input, and that's what we're doing here. We have 2 pages of output that cover 2 years. And the 2 years, you may notice, are in monthly format. There's a detailed month for each of those 2 years. What I tell people is that you should show the time period that would cover the investment that you're looking for. So here, I'm trying to raise $1.8 million at the beginning of my projection, right here. And that's going to last me till the almost until the end of 2 years. And so in my example, I thought I'm looking for enough money to take me out two years. And if I was looking for money that would last me 3 years, I would show 3 years. However, if I'm going over 2 years, I wouldn't show the monthly detail. I would probably switch to quarterly for years 3 and beyond. I'd be shocked if anybody, you know, at this stage was going longer than 2 years. I just don't see that very often. You know, it's often easier to break down this stage, you know, into a smaller chunk, which won't get you all the way you want, where you need to go eventually. But one thing that you might think about when raising funds is, how much money do you need? What's the least amount of money you need to get you to the next significant milestone where the company is more valuable, where you've taken more risk out of the company? Maybe it's you've developed a prototype, or you've established some early customers and proven success in some way, and now you're going to be ready to scale up, and you're going to need more money, and that's okay. This isn't to get you all the way to the finish line. It's to get you to the next pit stop of where you will be more, either you don't need any more money, or more likely, no, you need more money, but you've reached a point where the company is more valuable, less risky than it was when you first started. If you were asking for money only to last 1 year, I think I'd still show 2 years. So I wouldn't go less than 2 years, and I'd show the monthly detail. And I probably wouldn't go more than 2 years, but if I did, I wouldn't show the monthly detail. I get public companies forecast for much longer. And so a lot of people model what they do off of that, which I think is a mistake. And so they'll model an income statement and they'll model a balance sheet, and they'll do it for like 5 years, and they won't show monthly detail. They might show quarterly or just annual detail. I think that's a complete waste of time. Although appropriate for a public company, this is a completely different world where all we care about is cash flow. We don't care about the balance sheet except for the cash balance that's on the balance sheet. We want to know, how much money do you need? How are you going to spend it? When are you going to run out of money? What makes you more valuable when you get there? And what could go wrong with your forecast? So just in case, because I just see it a lot. I see a lot of 5-year, really difficult projections, and they don't do any good for the type of audience that you're looking for anyway. So just avoid those. At the something else where, we've got in green here, we've got the money that's coming in each month, and the red is a summary of the money going out each month. And so the net of those two is on this line. This is our cash flow, or our burn rate, as a lot of people call it. Sometimes non-financial information is very helpful to know just kind of what the company feels like. And a common one is head count, which we've got down here. That kind of gives you a sense of how much does it take, not just in money, but in people, and what kinds of people. So I think that's a good line to show. And then at the end of each month, we've got money coming in, we've got money going out. We started with the beginning bank balance of this. And so at the end of the month, if the projection really works out this way, we'd have $579,000. And you see it going down each month because we're having negative cash burn. And we've highlighted in here in red, which is the lowest cash point, just kind of pointing out to everybody like, hey, this is when it starts to get pretty tight. Speaking of tight cash, a question that often comes up is how much cushion, like if I thought, I really needed $1.8 million, and the lowest cash point was, say, let's call it 200,000. I guess I could have really raised $1.6 million, and I just hit zero here, right? Well, that'd be pretty scary because these are just guesses. And so it would be easy to be off a bit and run out of money before you accomplish that next stage where the company's more valuable. So a lot of people go the other way. It's like, well, why don't we just raise $5 million and then not worry about it? If you could, that might be good, but it might not be. It might be unrealistic that you could raise 5 million when you don't need it. With this cash flow would show that you're raising $3 million more than you really need. And so I think that would be considered significantly excess cushion, and that turns a lot of potential investors off. So you want some cushion. I find that there's no magic number to this, and it's certainly something you would want to talk about and negotiate. But maybe having raised 10% more than you think you need to help with some contingencies is good. But most investors don't like to give you a bunch of money to protect you from contingencies. They want you to manage the contingencies. And so instead of building a big cushion, they might say, what happens if you're wrong and it takes you 3 months longer to get to that milestone that makes you more valuable? You'd run out of money, according to this, before you got there. What would you do? And the answer shouldn't be we'd get more money from you or we raised more money to begin with. You know, would you go without salaries? Would you cut back? You know, what else could you do to make it through? That's what most investors want to hear is your contingency plan. Okay, back to kind of highlighting the important things in this big sheet of numbers. We highlighted here in green. This is when the company, in my example, became cash flow positive. So every month here, we were burning money. And then, wow, we turned the corner here. Now we're making money and the cash balances are going up. That's a happy day, right? Everybody likes that. Let's call that out. It'd be fine to add some notes, you know, on here, you know, any number that's an important number that helps tell your story that something important happened here. I think that's a great idea. All right, let me see here. Yeah, I think we covered all the things that, you know, all these things are examples of what I consider, you know, showing a clear format. And so once you've built your cash flow, I think this is maybe the most important part. I call it battle testing it. And by that, by the time you complete this and maybe iterate it several times, you're so deep into it, and this is your passion. This is your mission in life at this point. You're too deep into it to be objective. It's really helpful to have someone take a cold look at it and challenge you on certain aspects. And so, you know, this doesn't mean to show it to your family and ask them what they think, because they're going to say, oh, this is great. You know, you did such a great job. It means talking to your lawyer, to your accounting people, other trusted advisors that you might have on board, and run through your pitch with them. And this is something that I'll often do and do for free with people forming companies. Is, you know, I'll offer them you know, I'll give them one of these templates where they can build the cash flow, and then I'll say, you know, you know, here it is. Here's how to build it. Now go build it. If you have questions, ask me. But when you're done, come back. Let's spend an hour together and give me your pitch. And I'll pretend like I don't know anything, because I probably don't. I mean, tell me what you're trying to do. You know, give me the whole pitch and then walk me through your cash flow. And then let me beat you up a little bit. Let me ask you some hard questions. Remember, you know, I'm on your team. So I'm going to ask you the hard questions, but and before somebody else does. And I think that's super valuable to be challenged like that, so that when you come into a meeting and somebody asks you one of those hard questions, you're already prepared. So, you know, for example, kind of gave the example earlier, actually. What happens if this takes you longer than you think it does? Because it almost always does. So if you were asked that in a meeting, you might say, hey, that's a good question. We ran some other scenarios as contingency plans. And the short answer, you know, and I could show those if you're interested, but you know, the short answer is we would cut back here, or we have another way of making some money, you know, to fund our development, to get us, you know, to get us through, that doesn't require additional investment. So being battle tested early with somebody who's on your side helps prepare you for those difficult questions that you may get when you go to pitch it to a potential investor. The other thing you'd want to think about going in is, we all know your projection is a guess. You know, it's a fancy guess. It's your best guess, and you would know best, but we know that some things in there are going to be wrong. Some might be better than you think, some might be worse. Which ones are the ones to have the most downside risk? You'll want to think about that going in. Hey, what keeps you up at night about this projection? You know, I'm worried that that it could take longer, or that it might cost more to get the right people to help us get this done. But if it did, then we would have to pivot and we would do this. That, you know, if something were to go wrong, is the risk, I believe, in this projection, and this is my contingency plan for that risk. Another part of battle testing is taming the entrepreneur's, you know, optimism. So, you know, I love entrepreneurs. They're very passionate, excited people, and, you know, anything is possible. And yet when you come to raising funds, you know, the investors are much more cynical, more like me, and they probably perceive that your projection is too optimistic. The most common one is sales. If you're raising funds and you think you're going to have sales in that period of fundraising, most people overestimate the sales, and they do that by saying, well, you know, Gartner says this is a $3 billion market, and so if we could just capture 1% of that, which is nothing, you know, we clearly have more revenue than this. And you know, that's a classic example of how somebody comes up with sales, and it assumes things that aren't necessarily true, that you could even get 1% of a huge market. What makes you think that you'll even have something that could go to market? So I think that's okay to have those ideas and plans of the upside, for sure, but I think you have to temper that when you go to the cash flow projection. And then contingencies, we already talked about that. You know, be ready to answer those types of questions. We talked about cushion a little bit here too on this slide. We're talking about, you know, don't plan to burn the cash down too close to zero. Have a little cushion, but how much is too much? That's beauty is the eye of the beholder. My rough rule of thumb is, you know, raise enough money to where you have 10% of what you raised left when you think you're going to be done. That's my rough rule of thumb. And then, even if all the math on your projection works and everything, it's like, kind of so what? You know, ask yourself at the end, so what? You know, you raise the money, you spend it this way. Now what? You know, what have we done? You know, what's the upside? You know, what happens next? Do you raise more money? Do you need to raise more money? Why is this more valuable? Why did I invest, even if this comes true? Why did I invest? And so you clearly want to have a compelling answer for that question, and actually not even let it be asked. You need to come out with that and say, look, here's our projection. It takes us from here to there. What happens here is I think we're in a much better spot because now we're able to be cash flow positive, or we'll be able to raise more money, or we'll be attractive to a corporate partner, you know, things like that. So those are all things that I think are part of having your plan battle tested, is to ask those tough questions and be ready to and to have good answers for them, and at the very least to have shown that you thought about them too. You know, maybe you don't have the answers to everything, but to show that you've thought of that is, you know, you wouldn't want to be caught off guard with a question you hadn't thought of, even if your answer is not as good as you wish it was. You know, to show that you're prepared, I think, is very important. So that brings us to the end of the formal presentation. So pretty quick, sorry about that. I hope that's all right. But it does leave us plenty of time for questions. Matthew, I don't know if any came in yet.
So we haven't had any questions come in on the Q&A button, but I'm going to re-encourage everybody here joined us today to submit any questions if you have any. I recognize that when we're thinking about technical aspects of starting a business outside of the engineering itself, we just walk through one of the more technical bits. So if that generated any questions in your mind, please feel free to jump in. You can submit questions anonymously as well. So let's give folks a couple of moments to do that if they would like to.
Yeah, let's do that. And then I'll just repeat the offer while we're waiting to see if there's any questions we can share in the group. That I'm available to you afterwards, long afterwards. If there's something I can do to help you, I would love to do that. Whether it's giving you one of the two templates that we use and helping you figure out which one might be right for you, kind of coaching you, to use that, and then to also be, to help you vet it when you're done with the projection. And those are things that, that we offer free of charge, to our friends at UCLA. And so be happy to do that. It's a good way for me to get to know you. We would love for you to become a client of our firm someday. But at this stage, it might be too early. And, we want to help people with, when they need to be helped. And so if we can coach you along, happy to do so. As the companies grow, they need more, they become clients, we help them, we scale with them, their needs grow and their ability to pay to solve those needs grows. So it all works out. We don't need to try to make everybody a client. So don't worry that I would hard sell you or anything like that. So Matthew, anything coming in?
Nothing so far, but I do have a question from my own curiosity. Is when we're thinking about really technical founders like these, when they're coming up with numbers, what's the best place for them to get started on starting to fill out these projections?
Yeah, if you saw what went into this, it would help illustrate this better. But the back end of this, the input of where you put in, there are different sections. So there is a personnel section. What kind of people do you need, and what do they cost, and what month do you need them? Maybe you need employee number 2 3 months after employee number 1, because they have to get something started before you can even use employee number 2. So the format of this kind of helps you, and I tend to think of it around personnel cost. And even if the cost is 0, I still put the positions in. So if we have the founders and they're working, or others that are working for free, I do like to fill out that personnel section and count them as head count, because it's what it takes to get the idea going. To me, a lot of things revolve around personnel and the time that it takes. A lot of the other cost factors are driven off of how many people you have and when they come in. Well, we might not have lab expense until we get this type of researcher. And so I start thinking about what kinds of people do I need, when do I need them, and what do they cost? And the spreadsheet works that way too, if you saw the inputs. And then that helps drive some of the other numbers, especially the overhead type numbers, things like payroll tax and, things that people always forget, health benefits costs. A lot of those are driven off of the headcount costs as an estimation of, what people cost when you start hiring people. Well, hopefully that helps a little bit. Yeah, like where do you start, right? I think is what you're saying, right? Where do I start? And that's where I'd start, with building out the personnel plan. A fixed asset plan comes after that, and a lot of the other costs are driven off of all those things.
That makes a lot of sense. Thanks for walking me through that.
Sure.
So we haven't had any questions come in so far, so I think that we should just take the hint and let us wrap up here.
Yeah.
Larry, thanks so much again for joining us. It's really instructive to hear your point of view on how to approach making these projections, and I understand that this should be really valuable for the teams who usually come through Startup in a Box. So thank you for that.
Well, thanks, Matthew, and thanks everyone for attending today, and I wish you the best of luck in your endeavors. Have a great day.
Thanks.